SMCI has been on a downward spiral over the last 6 months, in fact crashing 60% and currently trades towards its 52-week low, and in fact now has a forward P sitting around 12.5. Now, what is going on with this company, and should we consider adding essentially before the 10-to-1 stock split next week? We're going to find out. Now, the first thing we want to understand is what happened just over the last few days, and the Department of Justice, who seem to have been very busy in the more recent period, have looked to open up. Now, this is reportedly a probe into the company. Now, where this stems from is the Hindenburg research, which took place in August, and they alleged there was some fresh evidence of accounting manipulation. Now, to what degree has this gone into the company, we don't know, whether some revenue figures are inflated or exactly where this affects the company overall, but clearly we can see if the Department of Justice are opening essentially a probe into this company, it doesn't look like good news. Now, we also need to understand that Supermicro makes computers that use as servers for websites, data storage, and other applications, and is effectively a major beneficiary of the AI boom that we have seen continued in the more recent months. And one thing that is very interesting to note is that when we do look at the heat map, in particular for the semiconductor industry as a whole, what we note is pretty much green for every single company. Yet when we do look at the computer hardware, which as we said does feed into a lot of these semiconductor companies, SMCI really the only one that is down, and significantly at negative 8.21%. So this is something we do need to consider. There are some bearish scenarios with this company, but there are also the flip side. This company has fallen significantly. Is it looking like it will rebound soon? And given the fact that Micron did report their earnings just last week, they have said from the numbers they've shown, very, very good numbers and forward guidance, that the AI demand continues to increase, and therefore the expectation is that companies similar to SMCI that help feed into companies like Nvidia will also experience some of that boom. Now, as we mentioned, this company is doing a 10-for-1 stock split. So what this means, if you hold one share of SMCI before the market open on Tuesday, you will end up with 10. Now, it doesn't change the value of the shares that you hold. For example, if it is a $1,000 share, effectively you will have 10 shares for $100. So just something to bear in mind. What it ultimately does is make it more accessible to people who can't buy fractional shares, or for people who prefer to buy shares at a lower cost. As we said though, it doesn't affect any of the fundamentals of the business. Now, what is also interesting to take a look at is how they performed in their latest earnings, which was just last month in August. And as we can see, that was when they announced the 10-for-1 stock split. And we also note off the back of that, the shares did come down around 13%. Now, a few reasons for the drop. Essentially, their margins, which we always like to look on this channel as an increasing nature for high quality, actually dropped to around 11.2%. As we can see, in the same quarter last year, it was at 17%, and from the previous quarter, 15.5%. So gross margins have been decreasing gradually, not a great sign of any company you want to consider. And when we look at the actual numbers, well, their earnings was a big fat miss, 6.25 as opposed to 8.07, and we see the revenue pretty much a very marginal increase, 5.31 to 5.3. So we've gone through this company, we understand there are some issues that we need to consider, and when we do come to the valuation, we will need to incorporate this into effectively our margin of safety. Now, we do note over the last 6 months, it has been downward trending around 60%. However, over the last 10 years, if you have been a shareholder, you would be up around 1,427%. But we do also note it is quite some way away from its all-time highs of $1,229. We also note Wall Street do give this a buy rating. However, both Quant as well as Seeking Alpha give this a hold. So before we jump into essentially looking at some of the financial metrics, we just want to refresh your memory with the latest quarter and their presentation. So when we take a look at their revenue for that latest quarter of 5.3 billion, we can see on a year-on-year basis as well as a quarter-on-quarter basis some very impressive increases. In terms of the full year for FY24, that was up triple digits at 110%. Now, in terms of the growth moving forwards, well, next quarter, they're still anticipating triple-digit growth year on year. And for the full year of FY25, we can clearly see 74 to 101. SMCI still believe that they can scale this company at a very rapid rate. Question we need to consider as we move along today's episode: how much do we believe this Hindenburg research, the DOJ, will affect not just the company in terms of the share price, but the underlying fundamentals. Are there any issues that we could perhaps envision in terms of them overinflating their numbers in a positive manner for shareholders? Now, the next thing that we just want to incorporate into the analysis is not the revenue, but also the gross margin, which we covered already. On a quarter-on-quarter basis, this is down 430 basis points. On a year-on-year basis, 580. Now, high quality companies, as always, they continue to increase their top line revenue, but they also increase their margins. And if you have seen any of our previous episodes on Nvidia, when we do the deep dives, their margins not only are very high, but they continue to increase. Now, we understand you can't compare companies in a slightly different industry, but we need to understand the fundamentals of the makeup of what we call a high quality company. As we can clearly see here as well, their gross margins have been decreasing pretty much over the last 5 quarters, and they do talk about this being down to both a customer and product mix change, as well as what they deem to be initial production costs on their new technology. Now, whether or not we see an increase to the margin moving forwards, this is definitely something we will keep an eye on, and something that if we continue to see this fall, we would ultimately call this a very, very large red flag indicator and perhaps make it uninvestable from our own perspective. And then finally, we can see here both the next quarter and the full year expectations. As we said, growth is still expected to continue at a very, very rapid rate. So now let's move on to the free cash flow and some of the metrics. With the free cash flow per share, as always, we want increasing consistently over time, but do understand the industry that SMCI is in is very cyclical, and in fact we do notice this from the free cash flow per share being negative 5 of the last 10 years. However, we do note over the next 12 months this is anticipated to increase to around $7.12 per share. In terms of sales growth, well, we already talked about how very, very strong this is, not only in the more recent year at triple digits. Moving forwards, they anticipate around 74 to 110% increase, and even previously still looking very good, nearly double digit every single year. And from a numerical perspective, we can clearly see here they've more than 7 times their top line, 1.95 billion to 14.9. What they've done that we don't like, but then again it makes no real difference, is the fact they have diluted your position as a shareholder year on year, issuing equity. That the reason why we're not overly fussed is given the fact that over the last 10 years, the share price has in fact increased significantly, that as a shareholder you wouldn't in fact really care. ROIC, as always, we want to see a minimum of 10% or more, just to give us faith management are able to effectively allocate their capital, and we can see that year on year, last year at 17%, as well as on a trailing 12-month basis, does give us faith in the team. Then we move on to the operating margin. Now, we already complained about the gross margin. Operating, we want to see efficiencies and ideally at a bare minimum around the 12% level. Now, we don't get the minimum, we also don't get efficiencies. It's gone from 7% to the lows of 3% in 2020, and then we have seen it peak to 11% before coming down. What this gives us is a signal of inconsistency, something that we need to be aware of, and if we do want to invest in this company, is have a very, very healthy margin of safety. Free cash flow margin as well, minimum 5%, not something we get in terms of the consistency basis. And the final metric, which has been one of their best, is the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Remember, this correlates to that balance sheet strength, and we can see these are the number of years it would take the company to pay off all of their debt net of cash on hand. We want below 1.5 for semiconductors. That is what we get, 0.39 in 24, expected to go to 0.18 over the next 12 months. So a very strong balance sheet, no worries whatsoever, and we will also have a very quick look at that shortly too. We also want to let you know we have released our latest free weekly article. In fact, we drop one every single Monday where we look at what's happened in the market as well as some undervalued dividend stocks to be aware of for your own portfolio. So do click on the pinned comment below, sign up so you do get that copy tomorrow morning. And we will also tomorrow be releasing our 36 undervalued dividend stocks for the month of October for your consideration, where we also cover those that sit within our own portfolio. And in fact, right now you can grab the spreadsheet running through 22 undervalued dividend stocks with the most upside according to Wall Street. So again, do click below to sign up and read straight away. Another part of our analysis, we like to look at insider and institutional movement. Insiders starting off 17.6%, quite high, around 55 million worth of sales by these insiders over the last year. But what we actually note in the more recent quarter, Q3, no buying, no selling. You have to go back to Q2 where we see the more recent sales of 1.12 million. And again, for transparency, for those that want to see who these insiders are, The more recent one would be on the 3rd of June, so you could argue a little bit outdated. Directors sold around 300 shares, $802, so significantly higher than the current trading price, from $241,000. Now, as always, we don't believe this to be a bearish signal. We just include this because we are trying to identify bullish signals, which is insider buying, management buy, because we believe the share price will go up. In terms of selling, well, it doesn't necessarily follow a bearish trend. They could sell for many reasons, personal and financial. Now, moving on to institutions, where we see 84% ownership, around $3 billion worth of outflows over the last year, with nearly double the amount of inflows. Although we do quite interestingly note in the more recent quarter, so Q2, a bit more selling, 647, than buying. Previous few quarters, we see the opposite. Now, regardless, this is purely for information purposes only. Whether insiders or institutions buy or sell, you always need to do your own due diligence before executing on any stocks. Now, we did already look through the revenue. We want to also highlight in this analysis the bottom line, but just to show you again, their top line revenue has been increasing at a very rapid rate, with the majority of the increases just being over the last few years. As we already mentioned, $2 billion 10 years ago to $15 billion in June 2024. How does the bottom line net income compare? Do we see a similar story? Well, from a graphical perspective, the answer is yes, as we can see that very large increase just over the last few years. And they reported $93 million in 2015. Right now, in that annual report, $1.2 billion. So good signs. As always, though, we do need to understand, is there any legs essentially to this DOJ probe? Any substance to what Hindenburg Research did tell us around a month ago? So again, just bear this in mind moving forwards. And then we already said the balance sheet looks very good, but as always, we'll do a quick cash versus total debt health check. $95 million of cash in 2015, $1.7 billion in their latest quarterly report, and we can see very inconsistent. Their cash amount, in fact, has increased just over the last few years, and when we compare that $1.7 billion to their total debt, both numerically and directionally, what we do in fact find here is that it is fairly low. $94 million in 2015, around $2.2 billion in that latest quarterly report, so not too far off the cash. We do understand, in fact, very similar to the cash, their debt has increased rapidly over the last year, that they aren't too far off, and therefore in terms of the health of the balance sheet, it does look fairly decent, as we saw a very low net debt to EBITDA metric. Now, in terms of the earnings, how did they perform historically? Well, they did miss quite substantially, as we just saw earlier today, 189 in Q4. Previous three, though, they did beat, and quite substantially, as we can see, particularly in quarter three. So a 75% track record. Just a shame that the more recent one was the miss. But we do note over the next four, they are anticipating very large growth, which if they do hit this EPS estimate of 44 for June 26, the forward P will come down even lower to 9.6. Now we're going to run through a few gradings and underlying metrics. First one, we have valuation. They've got a B. No surprises because look, P on a non-GAAP basis forward looking, 12.5 versus the sector of 24.4. Right now, if you are adding SMCI to your portfolio, you are paying a 49% discount. Now, it may be worth this company having a discount, but the question we need to understand is, has the market overreacted? Is this too much of a discount and should we take advantage? We can pretty much see on whatever valuation metric you use that SMCI is trading at a fairly lofty discount. Now, then we move on to the growth grade where they get an A, looking very good, pretty much A pluses across the board, 110% increase year on year, sector median at 3.1, forward looking, still expecting some very strong growth in comparison to the sector, and the earnings per share looking phenomenal if they do hit it, and that it is all legitimate, 45.5% year on year over the next 3 to 5 years, sector median 14.84. Now, where this is let down a little bit is that profitability. No surprises, as we've already covered this as well. They got a D rating. Gross profit margin 14%, very, very disappointing with the sector median at 50%. And essentially their net income at 8.1 is higher than the sector median. So if they can turn this gross profit margin around, this could become a very strong company and one to seriously consider. We do also note when we take a look at their cash from operations, negative 0.25 billion, which is shocking when essentially the sector is positive at 96 million. So understandable why they have that very poor profitability grade. Now, quick conclusion, we see a buy from Wall Street, a hold from Seeking Alpha and Quant, a B on valuation, A on growth, with a D on profitability. Now, before we do jump into our own valuation, We just want to highlight how they performed against others in the space. Now, as you can see, some very large names, similar sizes and in the same sector. Now, over the last year, SMCI, even after the drop, is still one of the best performers, up 63%, and we can clearly see the industry as a whole has performed very well. When we look over the last 5 years, we can see it is pretty much the best performer, and over the last 10 years, again, the same to be said there, no other company comes near. Question is it going to continue to fall down? Is it going to do a lot better over the next 10 years? Again, no one knows, as past performance isn't essentially an indicator of the future. Always good to understand though how it's performed against the sector, as well as if there are any issues in isolation for SMCI. So let's jump into our valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $524, we got this from the DCF model. Now, we're going to run through this in today's episode. We have the free cash flow growth year on year. Average growth rate is negative, as we can see, very skewed. In fact, 5 of the last 10 years have been negative. We have a low, medium, and high rate. We've gone for the 15% growth rate moving forwards. Using the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, intrinsic value 524, which ultimately gives upside of 25%. Now, ultimately, these numbers are all subjective, so you can grab a copy of the model by clicking on the pinned comment below, running through your own numbers, whether it's for SMCI or any others. Full transparency though, for those that believe 15% is too high, at the 10% level, we see 383, which indicates 9% downside. And for those that believe these numbers are way too conservative, well, at 20%, 712, which as we can see, a strong 70% upside target. As we said though, we're going to take 15%, the medium, in today's episode, run it through to the final slide. And we're not done yet because we always like to apply a margin of safety where we do start off with 10%. Now, we execute on 10% on this channel if it hits our 3 criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for Super Microcomputer, well, a buy up to $472. Then we keep going essentially till it's near the current trading price. And in today's episode, we can see we believe SMCI has a bang on 20% MOS. Now, whether you believe that or not, whether that's sufficient or not, given all of the bearish scenarios that we have discussed, or in fact, if you believe there are a lot more bullish catalysts, then maybe this is sufficient. We do know that Wall Street are very bullish though, $614. They see upside of 47%, and they do believe this is one to seriously consider. Now, in terms of margin of safety, for those that want to see what a 25% would be, around 393 is a buy, 30% around 367, and 35 around 340. As we said though, in today's episode, a 20% MOS, and for now, this isn't one we are looking to add, as we did see a few issues that we have, if not one of the largest, is that the margins do continue to fall down quite significantly over the last few quarters, and with the Hindenburg research, the DOJ probing into their accounting, it isn't really clear where the issues lie, and if in fact any of these numbers are inflated. As always though, do let us know your thoughts in the comments below. Is this one you're looking to buy, maybe holding, or maybe selling, and just doesn't fit in the portfolio? If you enjoyed today's episode, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter, which is dropping tomorrow morning, and also come and join us in the Patreon, where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.